The world's biggest oil lifeline is burning. Not in flames you can see, but in price, in pressure, in panic moving through the global system. Oil just crossed $100, and this time it's not just a spike. It's a signal that something deeper is breaking beneath the surface of the global economy. Because when oil crosses this level during geopolitical escalation, it stops being a commodity. It becomes a weapon. Think about this. A single disruption, a strike, a blockade, a threat, can push prices higher by tens of dollars in days. That's the David versus Goliath moment. A relatively small tactical move, triggering a massive financial reaction across trillion-dollar markets. And that's why this matters. Because oil is not just energy. It is the foundation of modern economies. Every supply chain, every transportation network, every industrial system depends on it. When oil rises above $100, the entire system feels it, and not gradually, but immediately. Now let's go deeper. Global oil demand sits around 100 million barrels per day. That demand doesn't disappear overnight. Economies still need energy. Factories still run. Goods still move. But supply? Supply is fragile, concentrated in specific regions, dependent on stable routes, vulnerable to disruption. Now add war into the equation. Supply chains are no longer just economic. They become strategic targets. Ports, pipelines, shipping lanes. And once those become unstable, the entire balance breaks. That's exactly what we're seeing now. Prices moving above $100 are not just about supply shortages. They are about risk, fear, the possibility that supply could be disrupted further. Markets don't wait for disruption. They price it in advance. And that's what creates the shock. Now look at the contrast. On one side you have a global economy worth over $100 trillion. Massive, complex, interconnected. On the other side you have relatively small points of failure, narrow shipping routes, key facilities, strategic regions. This is the vulnerability, because the system is built for efficiency, not resilience. And when efficiency meets disruption, the system struggles. Now let's connect this to inflation. Oil is directly linked to inflation. Higher oil prices mean higher fuel costs, higher transportation costs, higher production costs. Everything becomes more expensive, and that inflation spreads across food, across goods, across services. This is not contained, it moves through the entire economy. Now central banks react. They raise interest rates, tighten monetary policy. But here's the problem. The system is already overloaded with debt. Global debt has surpassed $300 trillion. That debt was built in a low-interest rate environment. Cheap money, easy borrowing. Now rates are rising, and that debt becomes harder to sustain. This creates pressure on governments, on corporations, on households. This is the financial squeeze. Now move to markets. Stock markets have been supported by liquidity, cheap money, investor confidence. But higher rates reduce liquidity, and reduced liquidity exposes weakness. Valuations come under pressure. Investors become cautious. Markets become volatile. This is how an energy shock spreads into financial markets. Now look at currencies. Countries that import oil face higher costs. Their currencies weaken. Their trade balances deteriorate. This creates instability, because currency weakness makes imports more expensive, which fuels more inflation. This is the feedback loop, and once it starts, it's difficult to stop. Now here's where it becomes even more dangerous, because this is not happening in isolation. The global system is already under pressure. High debt, tight liquidity, geopolitical tension. And now, an oil shock is being added on top. This is the convergence, multiple pressures hitting the system at the same time. This is how crises begin. Not with one event, but with multiple forces aligning. Now let's step back and look at history, because this pattern has happened before. In 1973, oil prices surged due to geopolitical conflict. The result? Massive inflation, economic slowdown, global instability. But something else happened. The global financial system changed. The petrodollar system was strengthened. Oil became even more central to financial power. Now look at 2008. Different trigger, housing, but the same pattern. A shock in one sector, spreading through the entire system, because of interconnection. Now look at today. Energy shock, financial vulnerability, global interdependence. This is the same pattern, but on a larger scale. Now let's talk about the hidden financial forces behind this. The first is leverage. The system is built on borrowed money. Leverage amplifies growth, but also amplifies risk. When conditions are stable, leverage works. But when volatility increases, leverage becomes dangerous. Losses accelerate. The second force is liquidity dependence. Markets depend on constant liquidity, but central banks are tightening, removing that liquidity. This creates stress, because the system is no longer supported in the same way. The third force is resource control. Oil is not just an economic asset. It is a strategic asset. Control over oil means influence over global systems. And in times of conflict, that control becomes even more critical. Now combine these forces: leverage, liquidity tightening, resource competition, and you get a system under extreme strain. This is not a normal market cycle. This is a structural shift. Now let's look forward. In the next 24 to 72 hours, markets will react to every development: oil price movements, geopolitical updates, central bank signals. Volatility will increase because uncertainty is high. But the real story is not short-term movement. It's long-term impact. If oil remains above $100, the pressure will continue. Inflation will stay elevated. Central banks will remain aggressive, and financial conditions will tighten further. This creates a dangerous environment for markets, for economies, for governments. Now consider the geopolitical fallout: higher energy costs, increased tension between countries. Energy importing nations struggle. Energy exporting nations gain leverage. This shifts power dynamics, and power shifts create friction. This is how economic stress becomes geopolitical conflict. Now here's the final warning: oil above $100 is not just a price level. It is a signal that the system is under pressure, that the balance between supply and demand, between stability and disruption, is breaking. History shows us what happens next. Energy shocks often precede major global changes: economic crises, political realignments, sometimes even conflict on a larger scale. The system doesn't collapse immediately. It destabilizes. Then it shifts. Then it resets. The only question is this: are we witnessing a temporary spike in oil prices, or the beginning of a deeper crisis that will reshape the global economy, financial system, and balance of power for years to come?